Hey navigators, Courtney Smith here. I've got a new theme and it's all about the price of oil. So we can play this in all of our navigators in different ways, and I'll talk about that later. Basically, we have an opportunity here to make money from the long side of oil and the short side. So this theme is really about a 1 year theme that I think is going to develop and we can make money from. So let's dive right into it. I'm going to go into the fundamental, historical analogous, seasonal, technical. I'm going to create a scenario for the price of oil, and then I'm going to create a trade plan. So this is a theme that's going to take a little while. This video is going to be, 20, 30 minutes long. Okay, the first thing that we're looking at here is what's called the term structure. The term structure. So in effect, it's like the yield curve, only for crude oil. Up at the top is Brent, down at the bottom is WTI, West Texas Intermediate. You can see that there's a downward slope, and what each one of the colored bars is the expiration of a futures contract. So the futures contracts that are going to expire soon are on the far left, and on the far right is where there are futures contracts that are going to expire in a couple of years, okay, in 2024. So we can now see that the nearby futures are much higher priced than the futures in the future. Now, what does that mean? Normally, it costs money to store oil. But the futures market is penalizing you for storing the oil. They're saying, we'll pay you more if you give us the oil now than if you store it for another time. So what that means is, that means that the supply and demand of oil is bullish. They're going to penalize you for storing it. They'll pay you less if you hang on to it. What the market is saying is, give us oil now. We're short of oil right now. We'll pay you a premium if you deliver it now. This is the single best way to determine what the supply and demand is, or the supply-demand balance is for oil. So this chart is clearly bullish. Here is a combination. This goes back to 2014. And there's a bar on there, which is really the, let's talk about the other lines as well. The dark line is the world supply of oil. And you can see it took a big dip last year, and it's been climbing up pretty solidly. The lighter line is the consumption. And you'll notice that consumption has been running above supply. So guess what? The term structure is telling us the same thing. There's a greater demand for oil right now than there is a supply for it. The bars show the difference between those two lines. So if we go back to early 2020, there was more supply than there was demand, so it was a big negative number. And then late last year, we started seeing that demand was higher than supply. And right now, they're very close, but still a little bit more demand than supply. And that's why the term structure is bullish. So here, we have a situation that's bullish, but just barely bullish. So let's take a look. So everybody wants to pump as much oil as possible to maximize revenue. And we're talking about the big producers. The U.S. is a big producer, Saudi Arabia. I'm in the United Arab Emirates right now. They're a big producer. Russia, et cetera, et cetera. You know all the names. So fact number one is everybody wants to pump as much as possible, but including Iran. So under Trump, there was all the sanctions on Iran. So Iran still sold oil, but they had to do it in, let's call it a black market. So they would transship it through another country, and then it would become that other country's oil rather than Iranian oil. Under the new Biden administration, we're seeing less pressure from the EU and the US. The EU never really put that much pressure, so we're starting to see more of Iranian oil come more back into the white market as well. So we're going to see a little bit of increase in Iranian oil. Venezuela and Mexico will continue to produce less due to deteriorating production capabilities. One of the things that people never really remember is that 80% of oil is pumped by governments, not pumped by the free market. In fact, really only the United States and a little bit of North Sea oil is free market oil. All the rest of it is government controlled. So what happens is, and this is really happening a lot in Venezuela, Mexico, to a certain extent in Iran, is that governments think short term. So what they do is they pump as much oil as they can, forgetting that they have to maintain their equipment. They have to always be spending money to upgrade their equipment, to repair their equipment. Venezuela and Mexico don't do that. So as a result, every year they produce less oil. Venezuela has the largest oil reserves in the world, and guess what? They don't pump a lot of oil anymore. So they're declining, even though they used to be major suppliers. So they're going to produce less oil, and that'll offset Iran. Russia is going to produce about the same. The UAE will produce about the same. Now, at $60 a barrel, some U.S., and we're about 65 right now. At $60, some U.S. production will come on the market. We'll see new production come in because at $60, some U.S. producers can make money. At $70, you'll see a lot of production come back on board. Okay, so to a certain extent, that's going to probably cap oil prices at around $70. But we'll come back to the scenario. So the real question is, what about Saudi Arabia? Because the two big swing producers are the U.S. and Saudi Arabia. But the U.S. is driven purely by economics. At $60, they can produce some. At $70, they can produce a lot and make money. So Saudi Arabia will remain the key swing producer. Now, they're going to try to keep prices, I think, around the current level or a little higher. They want the price to be as high as possible because they need money a lot, but they want to keep the U.S. out of the market. One of their big plays over the last year was to try to reduce the price to a point where the U.S. producers aren't producing because they can't make money. Saudi Arabia wants to be the only key swing producer in the world. So $65, they may want to keep it right here. They may try to get it up to 70 and see if the Americans come back or not. We'll, of course, keep a very close eye on that for you. So here's where the global demand is right now. This is from the IEA. Pre-pandemic forecast, you can see, was much higher than where we are now. We then had a big drop, and now their 2021 forecast, you can see where it is now. Up around a little less than 105, let's call it 104 million barrels a day. Okay, let's leave it at that. But will it really do that? Massive stimulus is boosting demand for all natural resources, and in particular gold. And so when I go back up to that picture, clearly we've seen a big rebound in the demand for oil. No question about it. So, and then with all the massive stimulus that we're seeing in the U.S., monetary stimulus in most countries around the world, and fiscal stimulus in most countries around the world, that is boosting demand for all natural resources, all commodities, and in particular oil. The U.S. is easing fiscal and monetary policies at levels never before seen in human history, creating what I call the Biden boom. But countries keep locking down. In today's newspaper, Malaysia is completely shutting down. The Philippines reported that they've added a bunch of new countries, that they're not going to allow anybody into the Philippines from these countries, including the UAE, which I'm in the UAE, and the UAE is one of the top 3 vaccinated countries in the world. But okay, fine. But the problem is that locking down, Europe is locking down again, a lot of it. Some of it's opening, some of it's locking down. It's a mixed bag. Africa's locked down. India's locked down. China's actually starting to see COVID making a comeback there. So we'll see if they're locking down little parts of China. But the point is that the locking down is still going on. We're seeing lockdown open, lockdown open, lockdown open. So the Biden boom, the fiscal and monetary explosion we're seeing around the world is still fighting COVID lockdowns. So demand will grow very slowly this year because of COVID. Now, what this means is, the way I'm looking at this is, the fiscal boom is going to be there. In the U.S., we're in the middle of the Biden boom. But global demand is not going to grow very much. It's going to kind of grow slowly as countries get more and more vaccinated and open up more and more. And so it's going to be a slow rebound, really, until the end of 2022 before we get back to normal from a global perspective in terms of oil demand. Next year, however, Biden's policies may create a recession because of higher taxes and anti-growth policies, including green mandates, pro-union. Once again, higher taxes, of course, will be the big one. So it's too early to exactly see what's going to happen. We can't predict it yet because we don't know what policies will actually be passed by Congress. It's quite possible that none of them will be passed by Congress. So right now, I'm kind of looking at the Biden policies that he's proposed, the so-called infrastructure program. And of course, it's getting pared back, and parts of it are being eliminated because he's trying to get some votes in the Senate, and even he's going to lose some of votes based on his policies right now. So he's going to have to pare it back even in the House. So we don't really know the final approach. But I'm going to assume that since the Republicans are proposing $1 trillion, that it'll be at least $1 trillion, but not the $6 trillion that Biden wants. It might be that they come to a draw and we get none. So we don't really know. But if Biden's preferred policies went in, I'm pretty sure we'd get a recession next year, and that would cause a big drop in oil demand because the U.S. is the biggest demander of oil. Okay, let's take a look right here. One of the ways to know what the supply and demand is in the U.S. is to look at this chart. This chart's very, very good. So what you see is, you see a gray band. And what the gray band is, it shows the range of crude oil inventories over the last year. So the top of the band was when we had lots of oil, and the bottom of the band is when we had little oil, and this is oil stocks or oil inventories. The light blue line shows where we are right now. Basically in the middle. So in other words, supplies are adequate, not excessive, not tight, which means prices should stay about where they are right now. Let's take a look at it in a different way. So this chart shows the total number of barrels. This shows days of supply. This is actually a better way to look at inventories of raw materials. So given the current demand, how many days of supply do we have? So the brown line is 2019 to 2020, and the blue line is 2020 to 2021. So you can see the tail end, obviously. You can see the COVID crash, blah, blah, blah. Okay, here's the point. If we look at the blue line, which is current conditions, we're actually really tight. We're down near the lows of days of supply. We have 32 days supply of oil. So that's bullish for the price of oil. I mean, we're not wildly bullish, but days of supply tells us, given current demand, how much supply do we have? And the answer is low supply. So as a result, this is a bit bullish. Not wildly bullish, but still bullish. So let's put this together now. Let's go back. I'll get to my scenario in a minute. All right. Here's futures prices. The brown line was last year, and the blue line is this year. So clearly we had the big COVID crash in crude oil. Yes, we made a tremendous amount of money on that. And the blue line shows a pretty consistent bull market in crude oil futures. Now let's switch to seasonality and historical analogous. So this is from mrci.com, more research. They do a very interesting form of analysis here. This is a form of analysis that they're the only ones in the world that do right now, okay? The only ones. And it's a form of analysis that I think is fantastic. So on here, you can see a chart of September crude oil, a clear bull market. Then what they did is they went back in time and they said, let's find all the years that had very similar price behavior. And they combined those years into the green line. Now, you can see here that what the green line says is we should actually see the market start to sell off here through the month of June, get a rally to new highs at the end of June, and then break down to lows in July. So in other words, a choppy but generally bearish scenario. Now, this is largely due to seasonality, which we'll look at in just a second, but remember that the price of gasoline is what dominates the price of oil. So the summer driving season actually ends with the 4th of July. After that, they're just using whatever inventories they have in stock. They're not buying any more gasoline. They're not distilling any more gasoline. So the price starts to sell off. So let's take a look at the seasonality now. So the green and the blue chart show current price action. We have a red line and we have a yellow line. The yellow line shows the seasonal price action for the last 5 years, and the red line shows the seasonal price action for the last 15 years. Now, it's kind of hard to see the scale down at the bottom, but it conforms with the historical analogous chart. The yellow line pretty much sideways until we get to October, and then it starts to sell off way over at the right-hand side of the chart. But the red line, which takes into account the last 15 years of price action, it peaks out at the beginning of July. Once again, the normal seasonal because of the driving season. So both the historical analogous and the seasonality are calling for a July peak. Now that's 6 weeks from now, 7 weeks from now. Okay, keep that in mind. So let's take a look at the weekly chart. This is a weekly chart, and you can see I've got a lot of lines on here. So let's break them down. We always want to start with the big picture from a technical perspective before we go to a shorter term. There's 3 red lines in the middle of the chart. Those are all major resistance. It's going to be hard for the market to get above them. The lowest line is at about $72, and you can see we're basically there right now on that weekly chart. Up above that, the second red line is about $76, and the one at the very top is around $86 or $87. So write those numbers down. That's potential peaks that we will reach in the seasonal rally. Okay, now let's take a look. I've got in the upper right hand corner, I have a black horizontal line and a short green line. This looks like an ascending triangle formation, higher lows and a flat top. Now, we don't know yet because, of course, it hasn't broken out of the top, but a formation like this normally breaks up and carries higher. One of the ways that we can see if it's probably a legitimate ascending triangle is to look down at the red line I've put down above the volume down at the bottom. Normally, an ascending triangle, a legitimate ascending triangle, will have a declining volume as we go through the pattern. And as you see, we have slightly declining volume down at the bottom. So I think this is a legitimate ascending triangle. If it is a legitimate ascending triangle, then when we break the high of that, which is at about 72, we should get the objective would be up around 84, which is very close to the 86 red line up at the top. So This chart is bullish. Now, I've got another diagonal green line, a long one. This is a trend line. I don't find trend lines to be very valuable. I put it on here because if the market starts to break down, it'll probably break down to that green line. But let's ignore it for a second. Then I come to another interesting line, which is the black line that is downward slanting, and I've put it above stochastics. So what this tells us, and it's not finished yet, if we break to new highs, I think it will be, it's not, we don't know yet, I think it will be weekly stochastic divergence. To me, this is one of my favorite techniques of all time, and it would call for a dramatic move down at least to probably $50 a barrel, okay? At least to the big green uptrend line, probably to $50, and maybe even down to $40 or $30 a barrel. So I'm watching that to see if we get a legitimate weekly stochastic divergence, okay? So right now, I would say this chart is generally bullish, that we would see a breakout above the highs we just made that'll cause us to go up to about $84, $85 per barrel. But there's the potential for a massive break to the downside. Now, can we combine those? Well, it's possible that we could see a sharp move up to 84, creating stochastic divergence, and then a big collapse down to 50 or 40 or whatever in the 4 or 5 weeks from now. That's a possible way that both scenarios could be true. We'll have to keep you up to date on that. Okay, that's the big picture. Now let's take a look at the short-term picture. You can see the ascending triangle here. We're very close to breaking out. I think that's the main thing we want to look at on here. Some of our other indicators like Conquer have not turned bullish. Coflex has turned bullish. 6-day swing, we could get into that right now. So, we've got a few indicators kind of running a little bit bullish here on this market. And we just today broke out of the 55-day high, which just came down. Now, because the 55-day high is just under that major resistance, I wouldn't take that buy signal. I'd wait for it to break that horizontal green line. Okay, let's talk about what the scenario is. Let's try to put this all together into a scenario. We're going to follow, I think, the near-term seasonal and historical analogous scenario of a little more rally, maybe more than a little rally if we get that ascending triangle, and then move into a sluggish bear move as we move into the fall. The rally might get up to $70 for WTI before U.S. producers start to flood the market. So we might set the cap at 70. Now that ascending triangle, if it breaks out, that might get us up to $80. Now if it happens quickly, remember there's a lag. If the price goes up to a certain level, the producers take a while to get their production going again. So we may see a pop into the low 80s before the U.S. producers are able to react and start to increase the market. Now the way I look at it is this. There's really kind of two scenarios here. One of them is sluggish up and then sluggish down. The second potential scenario is pop to the low 80s and then collapse to half of that. So we have to see what the volatility of the market is. If it breaks the ascending triangle on strong volume and a strong price movement, then we'll get the pop up into the low 80s, and that would be great because we make a lot of money on that. The sluggish up and sluggish down will still make money, just won't be as much. Let's carry on. Demand will be weaker than expected. Right now, everybody is saying, oh my God, the economy's booming. What they're really doing is looking at the U.S. and not looking at the rest of the world where it's not booming. And of course, that's going to be due to continued lockdowns, slow vaccine rollouts through most countries, including Europe, Canada's only 3% vaccinated. Asia, South Asia, that's India, Africa. That demand's going to take at least another year to come back on stream, and it may not be till the end of next year. So that would be like 18 months from now. But as the rest of the world comes on stream, the US and China will start to slow because of anti-growth policies in the US and China. For example, China's probably going to be instituting a property tax. They have a trial going on right now, but they want to expand that trial. Well, that means the housing sector is going to come under pressure, which means there won't be any new housing, which means the economy will start to contract. So anti-growth policies in the US and China are going to slow the economy, possibly even causing a recession in the US and very slow growth in China. Okay. So price moves to 70-ish, maybe pop to 80, then starts to fall below 60, maybe down as low as 40 due to slowing demand and increased production from US that is not offset by the Saudis. So we have to monitor this very, very closely, as you can see, because there's two potential scenarios here. So what's the trade plan? How do we make money? I think the optimal strategy is, depending on if you're trading stocks, options, futures, CFDs, etc., is to buy oil stocks, ETFs, oil CFDs, and futures over the near term. But for option traders, I'd sell calls against those positions. And because if it's a sluggish scenario, then covered call writing is always the best strategy to have in a sluggish bull market. Now, there are no options on CFDs. Well, maybe there are. I take that back. There are. I just have never traded them. And there are very liquid options on futures and options on stocks and ETFs. Should be able to create a nice profit with the covered call strategy, yet protect against the risks that I think are coming later this fall or later this summer, really kind of in July-ish, middle of July-ish, we might start seeing prices falter. But I think we've got a very clear direction. We don't really know what the magnitude of all this is, but we know what the direction is going to be. And that's the most important thing. If you have the ability to sell calls, that would be great. I think that would be a really nice trade. It's not like I'm not like wildly crazy about it, but I think we can make money on the upside in oil, and I think we can make money on the downside in oil this year. So that's my theme. Of course, we'll have specific trade recommendations coming up, hopefully later today, if not tomorrow morning at the latest. All right, we must keep a very close eye on our positions. On the long side, we don't want to get caught in a big bear move. So we're going to be very nervously long. Now, what does that mean? That means we might be taking profits on rallies. When we get up to resistance, we might take off part of our position, okay? We're going to look very closely at the breakout of the ascending triangle formation. Is it on heavy volume? And heavy volume would be a confirming factor. So we're going to be very nervously long. We're going to be looking to take profits. Normally, I like to ride things as long as possible, but this is a 7-week rally I'm looking for. So we're going to be nervous. Then when the bear market comes, of course, I'll always still be nervous. I'm always nervous. What can I say? But that move might be a much longer move, and so we won't want to be taking profits as quickly. We're going to want to let our profits run. How can I help you? Well, I'll be putting out trade recommendations in a little while, so keep an eye out for them. Thanks, everybody. Talk to you later. I've got more themes coming up, man. My mind's just going crazy. I think there's so many opportunities this year. Talk to you later. So the real question then is, how can I help you? Well, I can help you make money in this oil market, the oil stock market, by asking you to subscribe to Wall Street Winners. This is a publication that I've been putting out for over 25 years, and was ranked by Hulbert's Financial Digest as the #1 performing newsletter in the world. But now it's a very simple way that you can get involved. It's a weekly 20-minute video briefing where I go through the stock market, bonds, dollar, Bitcoin, you name it, I go through it. But the main thing is it comes out every Sunday night, so you're ready to go for the whole week forward. It has an online trade sheet, so I give specific recommendations. I say buy here at this price, sell here at this price. So there's no doubting. I give you my opinions, but more importantly, I give you specific trades. So in the case of oil, I may say buy Exxon at $52 with a stop at 45. I'll actually tell you how to exit, how to manage your risk so that you don't have any big losing trades. It's based on totally unique indicators and analysis. Just as you saw in this presentation, I use unique indicators that I have developed in my 50 years of trading through many, many types of markets, bull markets, bear markets, crashes, explosions, all kinds of things. But I really tell you what's really going on, not the blah, blah, blah that you get every place else, on TV or in the newspaper. I give you totally unique analysis that you're not going to see anyplace else that tells you who's doing what to whom. Now, I then, of course, tell you how to profit from it. There's no point in having a publication that just gives a bunch of opinions. Opinions are worthless. Worthless. It's just hot air. We have to take action to make money in the market. And that's where I come in and I start to give you specific recommendations. So these are concrete, actionable trade recommendations. This is not, as I say, I don't want to waste your time. I keep this thing tight and I talk real fast so that I can get the information to you as quickly as possible. Then you go to the trade sheet, you see the specific trade recommendations, and off you go. And hopefully you're going to make a ton of money from these recommendations. These are totally unique. This is not what everybody else is doing. When you see Wall Street Winners video newsletter, you're going to see things you're not seeing anywhere else. Nowhere in the world. Nobody's doing the kind of analysis I do. So you're going to be able to be out of step with what everybody else is doing. And the only way you can make money is to be out of step. If you're in step with everyone, then you get what everyone else does, which is losing money. You need to know what everybody else thinks, but then you need to be out of step in order to make money. So it's just $67 a month. You can cancel it at any time. So it's a peanut for the amount of money that you can make. Don't forget that newsletters like Wall Street Winners, they don't cost money. They pay you money. So what do you have to do to get it? You just have to go to WSW2021.com, WSW2021.com, and you can get up a subscription right away, claim your seat, get making money right away. I think you're going to really enjoy it. We have fun, and we make money. We made money every single year since I started trading 50 years ago. But we've also made money every year for 25 years since we've been doing Wall Street Winners. So we've been around for a long time, hundreds and hundreds of subscribers. Why don't you become one right now? That's WSW2021.com.